1962, if you had invested just $10,000 into Coca-Cola and never sold, never panicked, never moved, that investment, with dividends reinvested, would be worth over $25 million today. That is not luck. That is not timing the market. That is a system, a quiet, relentless machine called dividends. Let's start at the beginning. A dividend is simply a portion of a company's profits that gets paid directly to shareholders. Think of it like this. You own a piece of a business, and when that business makes money, it shares some of that money with you, just for holding on. Most dividend payments happen quarterly, 4 times a year. If a company declares a $2 annual dividend and you own 100 shares, you receive $200 per year just for being a shareholder. But here's what makes dividends so powerful. They don't care about market sentiment. They don't care about what's happening on Wall Street. While stock prices bounce around based on fear and greed, dividend payments represent actual cash flows from real business operations. Companies that pay consistent dividends tend to be mature, profitable businesses with strong cash generation. We're talking household names: Johnson & Johnson, Procter & Gamble, Realty Income, Microsoft. These companies have been distributing profits to shareholders for decades. Now, here is where the story gets interesting. The single greatest force in dividend investing is not the dividend itself. It is what happens when you reinvest it. This is called DRIP, Dividend Reinvestment Plan. Instead of taking your dividend as cash, you use it to buy more shares. Those shares then generate more dividends, which buy more shares, which generate more dividends, and on and on. This is compound growth. Albert Einstein reportedly called it the 8th wonder of the world. Let us look at actual numbers. Say you invest $10,000 into a stock paying a 4% dividend yield. In year 1, you earn $400 in dividends. You reinvest those dividends, buying more shares. In year 2, you earn dividends not just on your original $10,000, but on the $400 worth of new shares too. Small difference at first, but over 20, 30, 40 years, the difference is staggering. A study from Hartford Funds found that since 1970, reinvested dividends have accounted for roughly 80% of the total returns of the S&P 500. Not 80% of dividend returns, 80% of all returns. Stock price appreciation alone would have delivered a fraction of what patient dividend reinvestors actually received. That is the machine. Not exciting, not viral. Not all dividends are created equal. And this is where many new investors make a critical mistake. They chase yield without understanding sustainability. Here is the trap. You see a stock paying a 12, 14, even 20% dividend yield, and it looks incredible. But ask yourself, if this company is giving shareholders so much money, why is the stock price so depressed? Often a sky-high yield is a warning sign, not a gift. The market is telling you that investors expect the dividend to be cut or eliminated entirely. This is called a yield trap, and it destroys wealth. So what should you look for? 4 key metrics. First, the payout ratio. This tells you what percentage of earnings is being paid out as dividends. A sustainable payout ratio is generally below 60% for most industries. If a company is paying out 100% or more of its earnings in dividends, that dividend is on borrowed time. Second, dividend growth history. Has this company grown its dividend consistently over time? Companies that raise dividends every year signal confidence in their future cash flows. Third, free cash flow. Earnings can be manipulated by accounting. Cash is harder to fake. Look at whether the company generates enough real cash to sustain and grow its dividend. Fourth, balance sheet strength. A dividend-paying company drowning in debt is a ticking clock. You want companies with manageable debt, strong credit ratings, and access to capital markets if needed. Speaking of dividend growth history, let me introduce you to an elite group of companies known as the dividend aristocrats. These are companies in the S&P 500 that have increased their dividend every single year for at least 25 consecutive years. not just maintained, increased. Through recessions, through market crashes, through pandemics and interest rate spikes, and banking crises. Companies like Automatic Data Processing, 32% average annual dividend growth over 10 years. Companies like AbbVie, Emerson Electric, Stanley Black & Decker. As of recent counts, there are roughly 65 dividend aristocrats. Together, they represent some of the most durable businesses in American history. Companies with pricing power, loyal customer bases, and management teams that prioritize returning capital to shareholders. Historically, the Dividend Aristocrats Index has outperformed the broader S&P 500 with lower volatility. Lower volatility means a smoother ride, which means you are more likely to stay invested through difficult markets, which is the whole game. So, how do you actually build this machine? Here is a practical framework. Start with diversification across sectors. Dividend stocks tend to cluster in certain industries: utilities, consumer staples, healthcare, real estate investment trusts, and financials. Do not load up on just one sector. If you build a portfolio of nothing but utility stocks and interest rates spike, you will feel pain. Aim for at least 15 to 20 positions across multiple sectors. This gives you enough diversification to survive any one company cutting its dividend. Consider dividend ETFs as a starting point. The ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL, gives you instant exposure to all the aristocrats. Schwab US Dividend Equity ETF, SCHD, is widely regarded as one of the best dividend ETFs available, focusing on quality, yield, and dividend growth. Reinvest automatically. Set your brokerage account to automatically reinvest dividends. Remove the decision from the equation entirely. The moment human psychology enters the picture, should I buy more shares or take the cash? You introduce the risk of making the wrong call. And finally, be patient. Dividend investing is not a 6-month strategy. It is a decade-long strategy, a 20-year strategy, a retirement strategy. The machine needs time to build, but once it reaches momentum, it becomes something almost unstoppable. Warren Buffett once said that his favorite holding period is forever, not because he does not care about returns, but because he understood something that most investors never learn. The real wealth in markets does not come from trading. It comes from owning great businesses and letting them work for you, year after year, check after check. The dividend machine is patient, it is boring, and it is one of the most powerful tools in finance. If this video gave you value, subscribe to Market Mapped. Every week we dig deeper into the ideas that actually build wealth. No hype, just clarity. Hit that subscribe button and we will see you in the next one.